Please remember that futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I author in my weekly written reports. Prices shown on charts and quote bars are in real time and take into account all known activity up to this point in time. If you'd like to read more of this disclaimer, simply hit the pause key on your computer screen. I'm Boyd Baker, and thanks for tuning in to a new series of options tutorials where we're going to cover option strategies. Now, there are many different option strategies out there, depending on whether you're bullish the market, bearish the market, or neutral the market. Now, one good way to help explain this is by putting these strategies in an options ladder. And what we mean by an options ladder, it's meaning in the terms of delta. And we talked about the term delta in the past, that is the percentage change that your option makes according to the move in the underlying futures. If you want the most bullish strategy, we're talking about a delta of 100%, where you're long the futures or you're long a deep in the money call. If you recall, we talked about the gold market being around 1,200. Well, if you're buying a deep in the money, a $1,000 call, it's in the money by $200. You're going to have a delta that's going to be close to 100%. Synthetic long combos we'll talk more about in the next section. Long at the money calls, we talked about that. They're going to move at about a 50% delta, or about half as fast as the futures. Now, as you go down a vertical call spread where you're buying an at the money call, selling an out of the money call, it's going to be less bullish. And probably the least bullish out of this would be buying a way out of the money call. So if gold's trading at 1,200 and you bought a $1,300, $1,400 call that's several $100s out of the money, the movement of that option may only equal about 10% of what the futures is moving. Now, if you're neutral the marketplace, there's a couple of strategies that you can look at. One is a short strangle and the other is a short straddle. The short strangle is where you're selling a out of the money call and an out of the money put of different strike prices, and a short straddle is where you're selling a at the money put and at the money call of the same strike price. Now, when we're talking about delta neutral strategies, we're talking about you wanting to see your option premium decay. Options are a wasting asset. You want to see those premiums decline. You're selling those premiums high, buying them back lower, or hoping that the option premiums expire worthless altogether. Now, when we talk about bearish strategies, one of the least bearish strategies is buying an out of the money put. We talked about gold being around 1,200. If you're buying a $1,000 put or a $900 put, it's quite a ways out of the money. And again, you may only see that option moving at about a 10% delta. Buying an at the money put, such as a $1,200 put, remember that's going to move about half as fast as the futures, or a 50% delta. And buying a deep in the money put, that's going to be close to being short the futures. That'd be buying that higher strike price. So buying a $1,300 or a $1,400 put, that's what we mean by buying deep in the money. Those options are going to move at a closer to 100% strategy. So if you have any questions on this options ladder, remember, we're talking about the most bullish strategies and the most bearish strategies. We'll cover these in more detail in future videos. Do tune in. If you have any questions, feel free to call me here at 866-973-2079.